The next concept we're going to discuss is market volatility. So we see these big spikes of volatility. Volatility is measured by something called VIX. So it's basically measures volatility in the market. We had these big high periods of 2008 during the financial crisis, 2020 during COVID, and then during the tariffs, right? So this tariff spike was something bigger than we had seen since the 1990s, only two other periods. So it shows you the kind of fear that was out there. Now the VIX is pretty low because things have normalized, but these periods of time cause a ton of emotion, and they can be very dangerous for investors because in hindsight, these proved to be very good entry points, good times to invest when the volatility spiked. Kind of a noisy chart. Let me just highlight, we highlighted a bunch of things like the stagflation of the 1970s, the Volcker tightening, which is the Fed chair in the 80s, Black Monday in the 80s, the tech bubble, the global financial crisis, the pandemic, right? We highlighted all of these. So the thing that is really important is this box, right? We have the average bull market is 70 months up, which is, north of 5 years. The average return during that period is up 221%. Bear markets average about 14 months, which is an average return of down 38, right? So these ups and downs in the market can be pretty severe. And so the really important message when it comes to volatility is part of investing. If you can't handle volatility, we really shouldn't be a long-term equity investor because it's coming. It's going to come every year, and it's unavoidable. Even through diversification, we're still going to see that volatility because this is the S&P, and these little red dots throughout here show like what was the largest intra-year decline during for a year. So you look here, this goes back to 1980, 45-year cycle. This year says YTD, a good example. The markets through the end of June were up 5%, but during the year we had a 19% loss. So when we look at periods of time, even like I love referencing COVID because COVID was an example of the market at one point was down, you can see here, down 34%, but the year it finished up 16. So being a long-term investor is really important because this type of volatility is really normal. It's scary when you're in the middle of it, but it is normal. And the average intra-year drop through this 45 years is 14%, but the annual returns were positive 34 of the 45 years, right? So odds are that these long-term trends are in your favor, and you have to just kind of drown out the noise when it comes to volatility and get rid of the fear and be a much more pragmatic, long-term thinking investor. Along those lines, we're going to just dig into this whole concept of rewarding investor discipline. What does that then mean? So when we talk about volatility, an intra-year decline of 10% is not uncommon, right? So when we go back, this is a 98-year chart. Greater than a 10% decline happened 57% of the time. So that means if you're an investor, you should be expecting that, let's call it 60% of the time during the year, you're going to have a 10% decline. Then the reality is, what about a 20% decline? Well, that happened 30% of the time. So that means, roughly 1 in 3 years. And then what about a greater than a 30% decline? That only happened 10% of the time. So that's 1 of every 10 years. So that's what we have to prepare for as investors. 1 of every 2 years, we're going to expect a 10% decline. 1 in every 3 years, a 20% decline. And 1 of every 10 years, a 30% decline. That's historic data, but that is normal. That is very common. And again, part of just being a good investor is we have to embrace that. The other concept is this idea, don't be scared out of the market, right? So when we go through this correction period where the market's lost 16%, well, how did a diversified portfolio do against cash, right? Because most people, if you get scared, where do you go? You go to cash. So this is representing a little bit over a 40-year window that shows, 1 month after the correction, 3 months, 6 months, and 12 months. 12 months is, you're 13% better off than cash. And so again, historical performance is not going to drive. It does not necessarily mean that's what's going to happen in the future, but it's just a reminder of why it's important not to get scared out of investing. That's why we spend so much time building a financial plan and we make investment decisions around a plan, is that if your plan is intact, if your plan is in place, we've prepared for these declines because we know they're coming. We don't know when they're going to come, but we know when, or we know that they will come at some point. So that's why we build your financial plan with a diversified strategy so that we can weather this volatility and help you avoid being scared out of the market. And when we get into this, is just some more data that just shows the total return. I'll just focus on this first one here after a 10% decline. I guess we technically almost had a 20% decline, so let's focus there. 1 year later, historically, again, this goes back almost, we're at 98 years of data. The average return is up 21%, on a 3-year average is up 42, and on a 5-year average is up 75. So when we have these 20% corrections, that is, at least in the past, showed us this is a good roadmap for decently positive returns, subsequent or just after these downturns. So we're wrapping it up. So I think many of you know we're a growing firm. We've expanded. We have over 20 employees. We've expanded to Costa Mesa. We've built out a pretty solid 10-year plan to continue to serve more clients, to build a strong team, to really cultivate that next generation of advisors. So really proud that we have an amazing leadership team, an amazing company, and amazing clients, right? And so just wanted to thank you for all your years and dedication and support to what we're trying to accomplish. One of the things that we always want to make ourselves available, especially when you have times of volatility, is that, if you have family or friends that you think could benefit from meeting with us, send them our way. You don't need to pre-screen them. If they need some help, we'll do our best to serve them. And if we can't help them, we'll get them to the right place. And so just know that we're building our company to be able to accommodate growth, which again means being able to help more people. And so with that in mind, if you're already a Vance Wealth client, we understand, you understand we're monitoring the markets, the tax laws and interest rates. As we get towards the end of the year, we will be having year-end planning meetings. Most of them start in September and run through November. If there's some things that are popping up on your mind that you want to meet sooner, please let us know. Otherwise, your team will be reaching out. If you're new to Vance Wealth and you're just uncertain about what's happening with your tax strategy, your investment approach, or you just want a second opinion, we'll do a complimentary consultation. So please just reach out so that we can, we'll want to gather some documents, ask you some questions, and then we'll be able to give you a report that does a deep dive on your investments and your plan and give you some guidance, and maybe would be a good fit to help you on a go-forward basis. You can reach us, you can schedule an appointment, just go to vancewealth.com and you can schedule an appointment there, or you can call the office at 661-775-0950. Thank you very much. I hope you found our 2025 mid-year economic and market update valuable. Again, please like and subscribe on the YouTube channel, and we're looking forward to reconnecting in the future on our next video. Thanks.